Welcome to the Introduction to Accounting and Business, Part 5, Business Transactions and the Accounting Equation. The effect of business transactions on the accounting equation. A business transaction is any economic activity that directly changes a company's financial condition or its results of operations. For example, paying a telephone or utility bill, paying rent, buying land, providing a service, or making a sale. All business transactions can be stated in terms of changes in the elements of the accounting equation. Note the following. The effect of every transaction is an increase or a decrease in one or more of the accounting equation elements. The two sides of the accounting equation are always equal. The owner's equity is increased by amounts invested by the owner and is decreased by withdrawals by the owner. In addition, the owner's equity is increased by revenues or sales and is decreased by expenses. Let's look at some typical business transactions and the effect they have on the accounting equation. Usually, when a business is started up, an individual will take personal savings and open a business checking account as one of the very first transactions of the business. Depositing cash in the business checking account increases the balance in the checking account and thus increases the asset called cash. The owner's capital account is also increased by this transaction. When the company pays the telephone bill, a check is written and the cash account decreases. The telephone bill is an expense, which decreases owner's equity. When the company pays cash for supplies, the supplies owned by the business increases and the cash decreases. When the company buys land for the business, its asset land increases in value, while the cash account decreases. Let's take a look at how these transactions appear relative to the accounting equation. Using the accounting equation for the previous four transaction examples, we see that when the owner invests personal cash into the business, the asset side of the equation, or cash account, increases, and the owner's equity, capital, also increases. When the company pays for expenses such as the telephone bill, the asset side of the equation, or cash account, decreases, and the owner's equity also decreases. When the company buys supplies using cash, the asset side of the equation goes up since the supplies have value and are now owned by the business. However, the asset side also goes down because the company used another asset, cash, to pay for the supplies. So one asset went up while another asset went down. When the company purchases land using cash, one asset, land, increases while another asset, cash, decreases. Now, let's look at some more business transaction examples. A company provided services for a customer on account. In this example, the customer does not pay cash on the spot for the services received. Instead, the customer will receive an invoice and will pay the company for the services at a later date. The asset, accounts receivable, increases, and the owner's equity, fees earned account, also increases. Relative to the accounting equation, we have the accounts receivable asset side going up, and the owner's equity revenue going up. Both sides of the equal sign are going up in value by the same amount, therefore both sides are equal and they are still in balance. Sometimes a company will make a purchase by paying a portion of the sale price in cash and then paying the remaining balance due at a future date. In this example, a company is purchasing equipment and making a down payment in cash and promising to pay the balance due later. The asset equipment increases while the asset cash decreases. The difference between the full cost of the equipment and the amount of cash paid will be the amount that is due in the near future. This is a liability for the company, and we use the liability account called accounts payable. Here, if you can imagine the piece of equipment costing $1,000 and the amount of cash being paid at $250, then the accounts payable account balance would be the amount due, which is $750. Our accounting equation is still in balance because $1,000 minus $250 equals $750. The net increase on the asset side is $750, and the increase in liabilities on the other side of the equal sign is also $750. Often businesses will pay for expenses in advance, such as an insurance or rent expense. In this case, the company is paying for 6 months of an insurance in advance. This is known as prepaid insurance. This prepaid expense is an asset for the company because it has value until the months pass for which it is paid. Here you have one asset, prepaid insurance, increasing, while another asset, cash, decreases. Again, looking at this transaction using the accounting equation, we can see that on one side of the equal sign, the asset side, we have the prepaid insurance going up and the cash account going down for the same amount, which means our accounting equation is still in balance. In this example, the customer who promised to pay for the services performed at an earlier date is now making good on that promise. The customer is paying what is owed to the company, thus is reducing its accounts receivable balance. The cash account increases while the accounts receivable balance is reduced. If you look at row 1, you can see that this transaction entry was made when the customer received the services. We increased their accounts receivable account at the time of the sale. We also increased our revenue or fees earned account at the time of the sale. Now we simply increase our cash and reduce accounts receivable when the customer pays the invoice. This time, the company is going to pay off the liability it owes for the balance due on the equipment purchase. In order to do this, a check is written, decreasing the cash account. The liability is being paid off and therefore being reduced, since the company will no longer owe for the equipment. If you go back to the original purchase, we imagine that we would have a balance due of $750. Now imagine that the company checking account has been reduced by $750 and the liability, accounts payable, has also been reduced by that same $750, bringing the accounts payable account balance down to zero. Remember, regardless of the business transaction, The end result will always have the accounting equation in balance or equal on both sides. Always. Now let's look at the effects of transactions on owner's equity. Owner's equity is increased when the owner invests personal assets into the business, such as cash. Owner's equity is also increased when the business makes a sale or performs a service for a fee. We would use the sales or fees earned accounts in those situations. Owner's equity is decreased when the owner withdraws assets from the business, such as taking cash out of the checking account for personal use, or taking merchandise or supplies home for personal use. The owner's equity is also decreased when the company accrues expenses, such as rent expense, supplies expense, salaries expense, or utilities expense. Thank you for watching this video podcast of the Introduction to Accounting and Business, Part 5. It was made possible because of the generosity and commitment of the WICPA Educational Foundation to promote the career of accounting among high school students. Thank you.